Hello, this is the second video linking macroeconomics to the banking crisis. Now, in the first video, I detailed the way the economy works on the macro level, basically the circular flow of income model. And one of the important things about that model, it indicates how important the banking sector is to the functioning of a modern economy. Effectively, the argument is if the banking system failed, the modern economy would immediately fall into disequilibrium, which effectively means we get economic recession, we get large-scale unemployment, and we have serious problems. In part 2, this video, what I'm now going on to explain is how governments reacted to this. Now, part of the background here is the two great competing macroeconomic theories, which have had currency and ebbs and flows and their acceptance over the last 50 years. I briefly mentioned these in the first video. Basically, we're talking about the difference in Keynesian macroeconomic theories and monetarist macroeconomic theory. And a lot of this video will be talking about the changes brought about by using these. Now, if we look in general, there's government macroeconomic objectives which everybody almost will agree to. There is no enormous dispute between the supporters of either Keynesian or monetarist macroeconomic theory as to these objectives. So the objectives are fairly straightforward. Price stability, that is to say we don't want lots of inflation because that causes instability. Economic growth, a modern objective that every economy wants to have economic growth so that gradually everybody in the economy gets better off, or income increases and so on. And of course we want low unemployment or high employment, one or the other. Of course all these things are quite linked together. And in more recent times we've seen this need for governments to make sure they do not spend more than they can afford. This objective is probably more linked to monetarist theory than it is Keynesian theory. That the theory that the government should run as near as possible a balanced budget, and therefore should not go into great debt. And if they go into great debt, they should attempt to get out of the debt fairly quickly. Now, the two macro theories that attempt to explain how the macro economy works are these. First of all, be Keynesianism. This was developed by John Maynard Keynes, and it came to prominence in the 1940s, perhaps the 1930s, as a solution to the great problems that the world economy had in the Depression of the 1920s and 30s. The very simple understanding, and I emphasize in both these theories, the view I'm giving of them is fairly simple. For those of you interested in macroeconomics, you need to read a lot more about these theories to get the full flavour of them, or perhaps wait until you do these theories in macroeconomics in level 5 or 6. Okay, Keynesianism. The notion here was that the government had an important role in a complex economy, that the government had to manage demand in the economy. And one of the key understandings in Keynesian macroeconomic theory is that there's a trade-off between unemployment and inflation. If inflation goes up, unemployment goes up, and so on. There is an inverse relationship between employment and inflation. So that allowed governments in the 50s, 60s and 70s to check the state of the economy. If inflation was increasing, they immediately had to leverage. They took some demand out of the economy. If unemployment was increasing, they put some demand back into the economy. Now that Keynesianism was a view of macroeconomics that was used by most governments in market economies from the 1950s to approximately mid-70s, and it seemed to be outstandingly successful. Economies did actually grow and increase in trade and so on in those days. After the 1970s, we came to view the understanding of macroeconomics, the way the economy works, rather differently, and this is the view given by monetarism. Monetarism was basically, I suppose, not quite developed by Milton Friedman, but it became popular. He popularized this way of looking at the thing. Basically, this is a vision that markets work very well and governments tend to make a mess of things when they interfere in the economy. So that's a very important distinction here, where Keynesianism said government had a vital role to manage the economy. Monetarism basically says government has no role whatsoever, except a very minimal one, to manage the economy. The other important thing that monetarism said was that there is no long-run trade-off between unemployment and inflation, that they're distinctly different things. Inflation is caused by increases in the money supply. Unemployment is caused by interference in the way markets run. So they're distinctly different things. Now, if we look at, I'm afraid we have to just look at a little bit of economic theory. In the 1970s, most economies, including the UK, suffered from simultaneous unemployment and inflation. That is to say, unemployment and inflation went up at the same time. The very simple Keynesian theory couldn't cope with it, because the notion was only one of these things could happen at a time. The other would have to move in the opposite direction. The view of how an economy could be managed essentially changed in the 1970s to the monetarist notion, which says we control inflation by using interest rates. I mean, the best way of controlling inflation would be, of course, by controlling the money supply, but given that that's almost impossible to do, the next best solution is to use interest rates to control inflation. Essentially, in very simple terms, is that if inflation is going up, the central bank, the Bank of England in the UK's case, would increase interest rates. That would pull some money out of the economy, and inflation would start going down. If inflation is falling, if inflation is very low, the bank would actually lower interest rates. That would expand the money supply slightly, and therefore would again sort of cause inflation to just increase very slightly. So, for example, in modern times in the UK, the Bank of England tends to try and keep inflation at about 2%. The other thing that monetarist theory said was very important was unemployment. Remember that Keynesianism said the government could manage the economy to ensure there was virtually no unemployment. Monetarism says this is not possible. Unemployment can only be managed by markets. The role of government here is simply to set appropriate fiscal and regulatory framework to ensure that markets work well. And that's a microeconomy analysis, not a macroeconomy. This part of monetarism is essentially what is known as supply side theory. Again, for those interested, you need to read up this more. For our present purposes, I'm afraid I haven't got the time to go into this.